Welcome to the February 15th edition of Market Thoughts. I'm Dave with Lighthouse. We've got Friday the 13th out of the way, Valentine's Day out of the way, two of the scariest days of the year in the rear view, nothing but smooth sailing ahead. And we've got an international version of Market Thoughts this week for just the fifth or so time in the last 520 plus episodes of Market Thoughts. If I sound a little tanner today, that's why. So that's actually a lead-in though to something I want to talk about, not the international part, but the 500 Market Thoughts episodes part. We've been on a analytics journey that started way before AI became mainstream. It started with our things well that we reference all the time, our price signal, and then our market gauges. And more recently now our classifier models, our learning models that actually take all of that quantitative data and give us actual prediction of how likely it is, in this case 25%, that a price would be higher in the next 20 days or whatever days we specify, but these all focus on 20 days and what the expected price change is. That's the culmination of all of our analytics work, but there is no finish line on this. So what comes next, what's actually coming next for us now, and it'll be an undertaking, but we have all of these analytics culminating with these machine learning models. We also have 500 plus episodes of Market Thoughts, and nearly every conversation, email, phone call, etc., archived in the space between then and now. And we're actually just starting to undertake making our own micro LLM that actually would take current happening in the markets, a current prompt, if you will, and reach a conclusion on that based on what our years of insight have told us, rather than relying on our own forgetful brains, but just what that model can learn based off what we've learned over the years. So those mountains of data, weeks after weeks of doing this very thing, it's going to come in handy going down the road. Just a quick, we hadn't talked about what's next on the AI and analytics front in a few weeks. What's next is big. It's always big. And that's where we're headed next. More to come on that. But in the meantime, just back to what we always do and have always done. What were our weekly changes? March corn. Here's what we got done on the week. Ended up for the actual week itself, gained a penny and a half. This is 3 of the past 4 weeks since the bearish January WASDE report that March corn has gained. And I think in the process, here's how this played out. You've got this uptrend from back on those lows. We had a buy signal right here. You've got this uptrend. You actually breached pretty thoroughly that uptrend on Wednesday. We got kind of spooked. Maybe we're headed back to these support at these contract lows, turned right around, a couple higher sessions. So at a minimum, you're really locked into this range, it appears, for the short term. This support at 436, resistance at 436, that's held. We think it still holds. It's really a grind in here, but at least you didn't follow through on this breakout. You popped right back into the middle of this range. So corn chart wise at least looks comfortable to hold in this either side of 430 for another stretch longer. Then there's soybeans. March beans continued their social media potential soybean purchase inspired rally, further rallied virtually the whole week, took out the previous Friday's highs on this past Thursday. Inside session Friday closed lower on the day, but this is still a chart that's very bullish. You haven't seen any sort of confirmed top chart wise. This is maybe the first step of it, but it also could be nothing. You're 1 day removed from new highs and still very much a bullish look on the chart here, even as we doubt the veracity of the news itself. And then there's wheat. We had pointed out that wheat had closed within a dime either side of 570 every single day since the beginning of October. And that's a streak that was not broken this week. Once again, starting to get the framework of a breakout higher. You can see this going back to the most recent contract lows on January 16th. You've got this uptrend channel that's well defined, had a breakout on Thursday, but once again, inside session Friday, but didn't do much with it. Back down lower on Friday, still holding below your recent highs, much less this 590 upside target. So wheat is looking okay, but still not a lot to inspire that we're actually about to make a big move higher or anything of that nature. All right. In the middle of all this, we did have our February WASDE report. Not a lot to see here as expected. No changes on beans, slight increase to wheat carryout. Again, February report's not typically a big market mover. None of this was shocking. They did actually increase corn exports another 100 million bushel, cutting corn carryout by 100 million. Some things to pick away at here longer term, but this just fits with the general bullish demand situation for corn. And I'm not going to highlight world chart here, but it would show, as it has the last several months, that despite the large U.S. production and large production in general, demand is still outpacing supply globally, that the global corn balance sheet is not nearly as tenuous as the U.S. corn balance sheet is. So we got through the USDA report without any changes, really. That wasn't even the main driver by the end of the day, but just worth pausing on that because we want to keep this narrative going. We want to make sure we're well aware of where we're sitting on these carryouts as they change from month to month. Okay, so the other stories that we have then, or that we've been focusing on, obviously the main one making hay out of is this social media post roughly 10 days ago, a little over a week and a half ago, the previous Wednesday, where President Trump said China may actually buy 20 million metric ton of old crop beans, not 12 million. We focused on this in our next trade segment that went out this past Wednesday. That may occur just based off political goodwill, but it won't occur based off economics. Chinese soybean stocks at port are the highest they've ever been for this time of year, much higher than the 5-year average, much higher than they need to be. And the U.S.'s own USDA issued a statement in their Feb WASDE, alongside not making any changes to demand and carryout, that essentially said, if China does take more beans from the U.S., more Brazilian beans will cover markets that U.S. beans would have went into, which ironically could include destinations in the U.S. itself, essentially saying these politically motivated, politically goodwill purchases are not new demand, so it won't alter the global balance sheet. It will just shift where beans come from. But in amongst this, you've got the promised April discussion, excuse me, that'll be here before we all know it. You've got ahead of that word from both sides that they want to extend this trade war truce another year. A lot of positive, glowing rhetoric on both sides, and spec appears to want to rebuild potentially back towards a record net long position just based on that goodwill. And of course, you still have positive 45Z news for soybean oil. Soybean oil continues to rally. We don't view as much of a weather story. Mato Grosso corn planting a little behind the 5-year average, but not troublesome at all. Way ahead of this benchmark for problems a year back in 2020, 21. So you're right in the thrust of where you'd expect to be. And Argentine weather, there's still a dryness concern that persists, but we're looking at that's maybe a 2 to 3 million metric ton type crop loss, not the sort of thing that would even bring you back below record South American production. So we don't think weather is the story here. And the main story we have is a tricky one because it's politically motivated. It could change in an instant. So that's about it for fresh news. I think just in winding up what happens next, this is a good time too to just really step through our analytics that we're using to make decisions. So let's do this first with corn. If we look at this continuous corn chart today, you've got a signal at 54, top half of its range, away from the sell threshold. Mildly bearish, mildly supports selling, but not a screaming sell signal. And then if we look at our trend is actually lower on corn. So that's, again, it's fairly flat, but it is lower. So the trend is lower, signals at 55. If we look at market gauges, all important price to stocks to use is up at 62. That's getting up there. The other market gauges are 40 or less. So we would look at this corn chart and say, this is slightly above neutral. It's slightly bearish. It's definitely not screaming sell, signal below the sell threshold. Most of your market gauge is low. Then we pull in our classifier data. Here's what we're seeing. 46% of the time, corn is traded higher, and on average, corn has lost 4.5 cents. Again, slightly bearish here. So corn across the board looks slightly bearish in our analytics case. What does that mean? How does that translate to actionable action, if you will? If we look at nearby, still we've got slightly bearish analytics. We've got this major resistance just ahead. Nearby corn, stuff that needs to be priced in the next 1 to call it 2.5 months. In this window is still a good spot to do that. Analytics are saying we don't have to go higher than that in the short term. Longer term, there's almost no chance that we're at a significant high. Almost no chance we're at a significant high given that analytics look, how neutral it is. So that's how corn presents. Soybeans, quite a bit more nuanced. So here's what we're getting at in our soybean chart. You're at day 6 above the sell threshold, signal almost to 100. It's worth noting that there's not a gradient to these signal levels. 100 isn't necessarily a stronger sell than 75, for example. It's more about the duration that starts to really matter. But so you've got sell signal, and you look at your market gauges, all but spec net buying are above 60. And when this is updated with the most recent commitment of traders data, there's a weak lag in this. This will be too. So you've got market gauges. This is a bean analytics chart that really supports hedging. I mean, this is a strong sell indicator on soybeans. But then when we look at our classifier data, it gives us just a little bit more of a nuance. In the short term, over the next 20 days, the 62 data points in the last 16 years that were most similar to today, 65% of them featured continued rally over the next 20 days. You can see where they're highlighted on the chart here. Most of the time, you continued to rally. And if you tie that back to the underlying fundamentals, you're at a high leverage fundamental spot, because if China does take all those extra beans, you're headed higher still, no matter how whether it's new global demand or not, you're just headed higher on US beans until spec builds their max net long position. So this actually sets up pretty straightforward too. Traditional analytics strongly support selling. Prices rallied within range of its multi-year highs. It's a level that's profitable, both old and new crop for most growers, but it's a very high leverage spot. And our classifier data says we should still expect more gains in the short term. This is your option type hedging 101 right here, putting a floor in while allowing a ceiling. This is the exact high leverage spot that beans are in right now. Analytics are saying do that at a minimum. So that's how soybean analytics sort out. And reluctantly here, we're going to do the same for wheat. Wheat signal at 51. We zoom in. So that's exactly neutral. We zoom in. The trend is as close to neutral as you can get. You're 1/100th different, 1/100th of a penny different from Thursday into Friday. And so trend is essentially flat. You've got a really negative seasonal, 72 for a seasonal score. Spec buying is neutral at 50. Price to stocks to use is very low. Momentum is below 50. Range is above 50. This is extremely neutral analytics look. This is analytics look that says we should not expect to get out of this range we've been in the short term. How about that classifier data? Classifier data on wheat is actually quite negative. 104 similar data points over the last 17 years. Only 26 of them, or 25%, had higher price over the next 20 days and an average decline of minus 7.3 cents. So the classifier data is negative. The underlying signal and gauges are neutral. How does this shake out for wheat? Again, the classifier data is negative. There's definitely risk that you're going to fall, but we expect this contract low support to hold. We continue to hold to a revisit of this 590 for March futures is probably about the limit of the upside that we're going to see in the short term. So just as much as it would be nicer to see a more significant move, these analytics are saying that's probably about the best that we can hope for in the short term. Reminder, markets are closed Monday, resume with Monday night session. Could be an interesting one depending on bean news over the 3-day weekend. And we'll pick things up again here next week.